bring in a panel now, at least for some last thoughts, before we hear from Fed Chair Jay Powell in just about under 10 minutes. We're joined now by Joseph Minarik, the Conference Board Chief Policy Economist and former OMB Chief Economist under President Clinton, and Sarah House, Wells Fargo Senior Economist. Sarah, I'm going to start with you here, just on the expectation for bond yields moving forward. Right now, they have been edging higher. Right now, they have also made a slight move to the upside. We are stepping just a little bit closer to that tapering of that asset purchase program. Do you think we're going to start to see some of those bond yields really soar, especially once we do hit that start line on that program of the tapering?
Well, I think my colleague Zach just laid it out very well in terms of, in many ways, this is just the calm boat before the storm, before we probably do see some movement. But we think we're still a bit a ways from an actual tapering announcement. So our expectations is we don't get anything formal until December. And I think today's policy statement really solidifies that view when they talk about the fact that we are getting closer, but they're going to be discussing it at upcoming meetings. So that suggests that it'll be on the table again in September and likely in the November meeting before that they make that formal announcement.
Hey, Joseph. As Kristin just said, we're seeing yields go up a bit, indicating that some people are selling their bonds, and I apologize for the construction you're hearing. But essentially, the 10-year, the yield is essentially unchanged. What are investors telling the Fed? What is the market telling the Fed right now about the fact that we're really not seeing a big change in the 10-year after this statement?
The fundamentals in terms of the economy, in terms of economic growth, remain a little bit questionable. Growth is resuming, but to some people, there was an expectation of a faster recovery. Exactly what that's coming from, we don't really know. I think that looking forward to what happens as the benefit programs from the relief legislation come off is a useful marker. If people are concerned that workers are hanging out of the workforce and are not going to join until unemployment benefits go away, well, in about 2 months they will. And we'll see whether that brings a lot of labor back into the labor market and, potentially gives the economy a chance to grow more quickly. But we're not there yet.
Sarah, would you characterize this Fed as being a little too cautious, a little too tepid when it comes to wanting to move on those asset bond purchases? Because it's getting harder and harder for the Fed to make the argument that this economy needs $120 billion of asset purchases per month.
It is getting more challenging, particularly when you look at the inflation pressure that we've seen that continues to surprise to the upside and catch Fed policymakers off guard. But I think you have to go back to the fact that this is really an unprecedented environment. And so there's still a lot of questions over the actual course of the virus. So we've seen that in recent weeks with Delta concerns. To some extent, where we have seen prices jump pretty substantially in some sectors, there's questions over how much that sticks. And I think there's still a lot of questions over what happens with things like inflation expectations, as well as the labor response. So do we actually see workers come back in the fall? I think the health concerns emerging with the Delta variant suggest that might be a little bit harder, but you have the cross currents of potentially getting kids back in school, the roll off of those extra UI benefits. And so there's just a lot to sort through. And so I think that's why the Fed is taking a relatively slow approach, even as we have seen the broader economy improve and get closer to the Fed's goals.
Joseph, I want to pick up on a little bit of what Sarah is pointing to, at least when it comes to inflation. And what do you view as the durability right now of some of those inflationary pressures? You know, the Fed has been saying transitory. We still don't entirely know how transitory really is. We have supply chain issues, impacting inflation. We are seeing a housing market that is absolutely running hot. How are you viewing the durability of some of those transitory moves on inflation?
We still have a fundamentally innovative and competitive economy. We have a lot of markets where there is intense competition. Buyers have a lot of pricing information. It is very hard for sellers to raise prices in some markets. And as we go through a rotation of consumption, which during the pandemic, because people couldn't consume many services, they went out and they bought more goods. That created some of the supply chain problems. Now we're getting to the point where, God willing, we are going to get some more room against the pandemic. Workers are going to be able to come back to work. Kids will be able to go back to school. Clearly a lot of uncertainty there, but we hope, making progress. And at that point, we should see both increases in supply of services, more labor available in the market, and a little bit less pressure on the goods markets. And all of those will tend to lean somewhat against higher prices, greater price pressure going forward. So I'm in the transitory camp in terms of inflation for the most part, and I think that is where we're going to be.
Sarah, they dropped that line from the statement about vaccines, quote, reducing the spread of COVID-19. You think the people who pick over this thing word for word are going to make hay out of that and impact markets with that?
I don't think the people who are looking at this and the overall impact to market are really looking at how that component in terms of what the Fed's thinking on the vaccination and to what extent that's reducing the spread of the virus. I think they'll leave that to the scientists. I think really it comes down to what's their overall assessment of the economy. They continue to see improvement there, and it doesn't seem like they're overly worried about the Delta virus at this point. I think Powell will be pressed on that a bit further in the press conference, so we'll see how he responds to that and try and get a little bit more color of what came out of the meeting. But I think it really comes down to the overall taper as the number one focus of markets and Fed watchers right now.
And Joseph, are you surprised that the Fed didn't make more of the rise in inflation that we've seen just since the prior FOMC meeting?
I think what we've seen has been a continuation of pretty much the same kinds of pressures. Prices of used cars up, that's not an indication of costs in the system that are going to drive prices in the future. Housing, again, is to some extent, to a considerable extent, bidding on existing assets rather than dealing with the cost structure of the production of new products. So for that reason, I think what the Fed is trying to do is they're trying to convey confidence in their judgment about inflation, and you can argue about the extent to which they should show concern. But I think my reading is that they're sticking to their message.
All right, we're going to leave that there. I want to thank our panel, Joseph Minarik, Chief Policy Economist with the Conference Board, Sarah House, Senior Economist at Wells Fargo. Thank you both for joining us.